Today I'd like to talk about a very popular fixed index annuity that if you're someone who's been in the market looking at different fixed index annuities and you've done some searches on the internet, you've probably come across the Allianz 222. Now the Allianz 222 is right for the right person. If you're somebody ages between 45 as old as 60 in that age bracket, this might be something very attractive. Now, the Allianz 222 has a bonus. It has currently a 15% bonus, which is added to your protected income account value. Now, this bonus was recently as high as 20%, but then they recently lowered it back down to 15%, the original bonus. Now, when we say a bonus that's added to your protected income account value, that means it's not actually added to your contract value. So it's not a premium bonus added to your actual contract value or death benefit. So if you had another annuity and you wanted to transfer or roll that annuity into this particular annuity, you happen to have a surrender fee, a small one, of course. This 15% bonus would not cover that surrender fee because it's only added to your protected income account value. And of course, this is the value that's only used to calculate what your income is going to be. So we're focused on that particular value. Now, I'm going to create an illustration using Allianz's own software on their website, just like I do for any client who would be looking at this type of investment vehicle to create an income stream. Now let's go into the website here. We're going to create one for a male. Let's use age 51. He's in the state of Florida. And one drawback, let's use $250,000 as the cost basis. If you were transferring a 401k into an IRA, you wouldn't have a cost basis. But let's use $250,000 ordinary or non-qualified money. And one of the drawbacks on the Allianz 222 is this. You cannot turn on your income or protected income account value for a minimum of 10 years. You have to wait at least 10 years before you can turn it on. So we're going to start the income here in year 11. This is why it wouldn't be attractive to somebody, let's say 70 years of age. They want to turn on an income in the next year or two. They can't wait that long. Then this would not be appropriate for somebody in that age bracket. But if somebody is 40, 45, 50, and you got some time before you're going to start turning on your income, you have an IRA that you can't even take out income anyway until age 59 and a half or older, then this would be appropriate. Now, we're going to go to quick view here and then jump over to the actual illustration. Actually, let me go back again. Let's go back to product again. This is one part I left out. We're going to link it to an index. Now, with all fixed index annuities, you're not actually in an index. So if an advisor is selling it, making you think that you're actually in an index, well, you're not. You're in an insurance contract that is linked to an index where the insurance company is saying if the index does this and this, we're going to add this to your contract value, subject to whatever cap rates exist on that particular strategy. Now in this case, we're going to use the Bloomberg U.S. Dynamic Balance Index 2 annual point-to-point strategy. That's been working out the best. Now that index hasn't been around that long, but the elements within inside of it have been around for quite some time, so that's why they can go back and do an illustration showing what it's done in the last 10 years or so. Just to give you an idea what that looks like. Year to date, that index has done, 11.84%. Let's go to a quick view. Now we're going to go and create the actual report, the illustration. we're going to pretend that the client looking at this particular annuity was 51 10 years ago. So we're going to look at the page that actually counts. Go down to page 8. The last 10 calendar, or most recent 10 calendar year period. Now, here we start out with $250,000. Now, the way this works is Allianz is linking you to the index, but they're giving you, they have a cap rate on this particular strategy. Currently, it's 3.5%, which is not that high, meaning that you can't make more than 3.5% on the accumulation value. The accumulation value is the actual contract value, which is synonymous with the death benefit. But every time they add a credit to this contract value, they're going to add a 50% bonus on top of that credit to the protected income account value, or PIV. So you're in 3.5% here. They're going to add 5.25% over here. You had 3.49% credit is added here in year 2. They added 5.23 over in the protected income account value, and so on and so on. And that's accumulating. This is what your income is based on. It's, based on this protected income account value. We're not solving for a death benefit. We're trying to create a pension. We're trying to create a pension that outpaces inflation, so you don't outlive your money. Many clients come into my office, retired a lot longer than they actually worked in some cases, and they never expected to live this long. So this type of fixed index annuity is attractive because it creates a guaranteed income stream. What's unusual about the Allianz 222 is once you turn on your income, after the deferred period is over, you're deferring it for 10 years here, your income can move up with the index, and every time it does, it locks in. So here in the illustration, it's 61, you turn on the income, and your first year income in the illustration is $22,779. The following year, you got a bump to $23,975, and the following year after that, $25,230. Every time you get an increase in your income, it's locked in and it does not go back the other way, so it can only go in one direction. Now, like all annuities, you're depleting your contract value over time, because the amount that's credited to the contract value is not going to keep up with the payout. We're not solving for that. We're creating a pension. And this is exactly what pension companies do. They use this type of method to create a pension. Here we have a pension that's not fixed. And this is unusual because most fixed index annuities, once you turn on that income, it's fixed. It does not move up. Here it's actually moving up with the index. And you notice if you get down to year 24, the index is, the actual contract value is depleted to 0, but you're still getting bumps in your income. They're still giving you a raise based on credits in the contract, even though there's no contract value left. That's unusual. Now, you notice if you make it here to age 80, your income's at $54,347. You've taken in $744,479 from $250,000 as the original investment. This income continues for the rest of your life. You can also choose joint life. This is a single life we're looking at. And if you choose joint life, that's a little bit less of a payout. If there's a big difference between the ages of the couple, then of course it could be quite significant. So going back here to the deferral, one thing you need to know is, do you have access to your money? Well, yes. During this 10-year deferral period, you can take out up to, if you're over 59 and a half, up to 10% of your original investment without a surrender fee. If you went over that 10%, then you'd be subject to a surrender fee for that year, and each year it gets less and less. After the 10th year, you're out of the surrender period, then you can take as much as you want out of the contract. And you can turn on income anytime you wish after that 10th year. So this is the 222. This is why it's so popular. It's popular because you have an increasing payout option. You have a 15% bonus that's added to your protected income account value. And one other feature that's unique is you can take the protected income account value as a death benefit. So your beneficiaries, let's say something, God forbid, happened to you in year 12 here, just as an example, and your beneficiary wanted a lump sum, well, then they would only get $315,000. But if they took a 5-year payout, they can take the protected income account value of $436,548 over a 5-year period, lowering their taxable income. So that's it in a nutshell, and that's how the Allianz 222 works.